Our guest this week is Zach Coelius, managing partner of Coelius Capital. Zach is a four-time entrepreneur and now solo GP who invests in early-stage technology companies. We talk about why ideas are meaningless, demo day investing, sniffing out product market fit, and why Zach thinks ownership is overrated. This is a really fun, candid conversation. Hope you enjoy. Zach, thanks for coming on the show.
No, my pleasure. Thanks for having me.
So I want to start by getting you rolling about a line that's on your website. It's in big, bold font, and it says, ideas are meaningless, validated ideas are priceless. Can I get you to riff?
Yeah, so the simple explanation for that is every founder's got ideas. You go through the life, you experience the world, stuff annoys you. Like right before we started talking, I was having problems with my mic and my setup here, and I was like, so annoyed. So I have ideas about how to fix them. Every founder has ideas, but your ideas are meaningless. Like what really matters is, do customers really want that? Do they desperately need what it is that you have? And a lot of people don't ever go out and talk to their customers. And so validating the fact that the ideas that you have are valuable. What I like to say is, until you can cold call a customer, so you don't know them, at 9:00 at night on their cell phone while they're putting their kid to bed, and describe what you do in one sentence. And instead of them saying, fuck you, why are you calling me? They're like, ooh, I want that. You don't have anything. But when you get to that point, that's the magic of finding the very beginning of product market fit. That's when you have something that people actually want. When Travis and I first started Uber, he and I were at this party and told him the idea. And I was like, oh my God, I want that. Now, to prove how much of an idiot I am, we proceeded to argue for the next 2 hours about whether or not he'd get to the taxi lobby. But the value of the idea was so good. I was like, push a button, get a car. In San Francisco back then, it was just so painful. And yeah, so that really is the most important thing, is whatever your idea is, go into market. And I like to tell people that the cold LinkedIn message test is just like that cold calling test, which is if you can send people cold LinkedIn messages and they respond to it, boom, you got something. Because people actually do look at those cold LinkedIn messages, and then every now and then they'll respond if you have something valuable. That's what you're looking for. You're looking for value that people really want.
How do you sniff out product market fit before it's obvious to others?
The metaphor I like to use is that when an entrepreneur first starts, come up with an idea and you decide to start working on it. So I'm gonna go build this thing, and you get whatever resources you can get. If you're Elon Musk on day one, you've raised $1 billion and you're off to the races. And if you're fresh out of college, it's maybe you. And for me, it was me and my sister. So nobody. We're just getting started. And you go into the wilderness that is being an entrepreneur, whatever supplies and friends you got, and you go into the wilderness to try to find something valuable. And that process of talking to customers, trying to build stuff, hey, I got this idea. The difference between an idea and trying to build an idea is pretty huge. Realizing the limitations of the technology that exists, realizing the limitations of the resources that you have, you come face to face with reality. And you're wandering around in that forest trying to find the gold mine that is product market fit. And what's interesting is that when you do find it, usually what that means is there's a crystallization, a simplification of the value proposition. It becomes clean and clear. That when you talk to an entrepreneur who hasn't found it, you'll ask them what they do, and it's always the same. You're like, what do you guys do? Well, we do this, and there's all these little, and when they find the thing that really works, there's no ands, there's no wells. It's just boom. For us, it was dynamic retargeting on Facebook. That was it. I mean, when we'd call up customers, they say yes to that all day long. And that crystallization of the value proposition, the articulation of what they do in a way that customers really care about, it always precedes the beginning of sort of quantitative product market fit, which is month over month metrics. Sales, revenue, users, all the things you usually see in a graph. That sort of enunciation of value precedes that. And so what I spend a lot of my time is looking for that, which is what is it that you guys do? And then being able to be oh, I get that. And then the customers can get that. And then you can sort of like make the whole thing a sort of unified experience.
You talk about liking weird ideas. How do you suss out whether something is weird in a good way or weird in a bad way?
It's so hard. I don't know if I'm good at that. So I'll tell you, I love this story. Beginning of this year, one of my friends reached out. He's like, dude, I got the weirdest, best entrepreneur. You should talk to this guy. And I was like, sweet, done. Let's talk to him. And he was building mirrors that you put in space to basically take sunlight and then condense it through a telescope and then land that on a solar farm so that the solar panels could continue to generate electricity after dark. And he walked me through the whole thing, and I was like, whoa, that's so cool, so weird, so scalable. I mean, there's so many ways that's awesome. And I ended up spending much time with him and trying to be helpful and introduce him to people. I'm not an expert in space by any stretch. And usually what I do when I get a deal like that is I try to find people who are smarter than I am in the space to like get them to coalesce around the idea, and then I can sort of draft behind them. In this case, I wasn't able to put that together. And I didn't end up doing that deal. Sequoia did that deal a couple months ago. And now I'm like, nah, I wonder if I should have done that deal. But it's, I think, a good example of like, if there's a category of companies that are doing the same thing, it becomes much, much more difficult to figure out who's the best at sort of the state that I play at, which is the product market fit level, like sort of like, because when there's like 6 or 7 companies that have all found that, now basically my odds become much lower of that being the differentiation. When you're the first company to do that, you're weird by definition because there's no other validation. There's no category. There's no other players. You don't yet have sort of the month over month metrics to like really, really enunciate that this is going to make it. And so for me, it becomes much more of a qualitative exercise versus like looking at it from a quantitative perspective. And so I'm looking for the like, you hear this a lot in venture, the N of 1 weird, not normal sort of like stuff that people don't really understand. It's hard to find, but that's what I look for.
How does the founder's experience as a prior entrepreneur or not, or industry experience play into your enthusiasm for backing them?
I mean, I love experienced founders who I've known for a long time. So Kyle from Cruise, Ahmad from Mercury, a lot of Itamar from Apprente and now 10X. Amazing founders. It's super easy. When they call me up, they're like, I'm doing something new. I'm like, like, go for it. For founders who I don't know, who are deeply experienced, it can be a relatively challenging signal because a lot of other investors do know the people. And so you end up with very high prices, but I don't actually have the data to like deeply understand the way they work, the way they make decisions. And you end up with a great entrepreneur, great price, and I'm not smart enough to really know that that person is great or not, because there's a lot of entrepreneurs who have deep experience who just are terrible. Like I would never want to work with them. And so I end up with a lot of either founders who I've known for a long time, and then those folks, not always guys, but those folks, I love those folks, or relatively young entrepreneurs who it feels like there's a significant market mispricing oftentimes with them because you are taking a lot of risk. It can be very painful to work with them. So I like them.
You mentioned you generally invest in B2B companies. You also do B2B2C. I think B2B is pretty well understood, the attractiveness of that, and we focus on that as well. But B2B2C is one that doesn't get as much play. Yeah. What interests you about that model?
I think that complexity, right? So one of the companies that I invested in a long time ago is a company called Booksy. So Booksy is Warsaw-based, billions in GMV, very big business now, company that provides software for hairdressers and nail salons. Seems like a terrible category. SMB, small, high CAC, high churn, like not traditionally a good category. But the thing that got me really excited about that deal from the very beginning was the founder really walked me through. It's like, okay, we acquire a hairdresser, boom, and they cost X, great, super expensive. We make Y, doesn't really work, and we get all their customers. So all the people who are customers of that hair salon now start using our software, which we then are able to provide them with services for other things. So we get to get them for nail appointments. We get to get them for other beauty services. And suddenly we become their beauty app for scheduling beauty, which is an incredibly valuable piece of software. But going out and acquiring those consumers one at a time is relatively difficult and painful. And so those sorts of business models where you get leverage as a result of the acquisition of the customers of the businesses, and then you can use that leverage to provide really valuable incremental services to those customers, I get really excited about. They're much harder to execute. You need to be a very experienced entrepreneur to pull that off. And you have to be super careful about founders who come in saying, oh, we're going to do this thing, A, B, C, and like, you realize that C is a lot of hand waving. You see that a lot in ad tech where they're like, oh, we're going to go acquire all these customers to get their data. And then you're like, oh yeah, what's the data good for? And they're like, well, data, valuable. Like, come on, what is the specific value? But it's, that's an area that I like to play in. That's more, the more complicated, the better. Those things, I enjoy that.
The C on the end is pretty compelling as far as CACs. I mean, one thing I'm curious about, and you've probably heard this narrative of B2B SaaS over time has gotten pretty well strip mined. So the opportunities keep getting smaller. CACs are hard to work with. What's your view of B2B SaaS today as a category?
Like I said, it's pretty well strip mined. I think AI is changing the game. So you've got like product deltas that happen as a result of utilizing AI, which I think is creating sort of some breakouts. So some companies are able to grow more rapidly than others if they're able to figure out how to make that work in their category. And then I think you have significant rethinking of the actual value proposition and the product and the interaction layer and potentially even the modalities of the users, which we haven't yet seen in a significant level, but looks like it's probably going to play out. So I do think AI will kind of like jumble all the pieces in the B2B SaaS world. But yeah, no, it's a pretty established category. That's why I find most of the deals that I've done in the last couple of years have been in the less traditional SaaS space and more in sort of software that businesses use, but not in sort of a traditional SaaS category. Yeah, pretty long in the tooth, until AI started happening. Really.
Are you still actively investing in ad tech? I know listeners may not know, but you have a very deep background as an entrepreneur there. Is that an active space for you today?
I just did an ad tech deal, which is my first in many years, which is kind of crazy. I think ad tech ad tech gets a really bad rap because if you look at basically the outcomes of ad tech, AppLovin and Trade Desk alone pay for all of the capital that was deployed into ad tech over the years there were bad ad tech investments. Everyone was like ad tech deployed a bunch of capital, and then there was years of trough of disillusionment after everyone lost a bunch of money in a lot of those deals. But now, once again, the winners have paid for all the losers. And so if you were in the winners, like some of my LPs were in Trade Desk, they own a winery in Italy now, and they're very happy. You win. So I think ad tech was and is a great category. You just have to be, you have to be in the winners, which is very hard. And it's a complicated category, like every other mature category. But yeah, I just did one, so I'm still excited to find stuff there.
How do you think about platform risk with ad tech? And maybe I don't know if you want to go into the story of your experience with that, a very pointed one. But it's something it comes up in almost every ad tech deal that I look at, and I go back and forth on.
I like to say that I have a scar from here to here, from my belly. I've been gutted by Facebook. It was like right before Facebook went public. They'd missed their Q4 earnings because at that point their ad platform was very immature, and Zuck goes to the ads team. He's like, "What should we do?" And they gave him 10 different ideas. He greenlit all of them. He's like, go do stuff. Because they missed hard. And one of the ideas was championed by this guy named Antonio Garcia Martinez, who wrote this book, Chaos Monkeys, which is still, I think, one of the best books about sort of Silicon Valley startup life. It's a great book. And his idea was to bring in external ad tech providers like my company to provide basically an ecosystem where outsiders could basically bid on the inventory on Facebook, a marketplace, and we could use our technology applied against their inventory to drive performance for advertisers. And so we had been one of the early competitors to Trade Desk, but I had started as a 25-year-old kid in the DSP market, and the Jeff Green was like my age now. So I can only imagine like competing against 25-year-old me. Like, I mean, I would kick the shit out of that kid. So I think what happened is that other folks in that ecosystem were all my age now, and they were very good entrepreneurs, and they kicked the shit out of us. So we had been ejected out of the back of that pack and weren't really a viable player in that space. And so we just sort of bet it all on Facebook. We're like, we're dead anyway. Let's go. We knew the platform risk. We knew it was there. We're like, let's bet on taking a swing here. And God, it worked. I mean, so their average click-through rate when we first started working with them was for every 2,000 ads, they would get 1 click, which is pretty poor. And the 3,000 ads, it was very low. And we basically drove that up 10x. So the performance for their advertisers went up 10x as a result of our technology. And the CPMs went up 10x as well. And the performance all the way downstream to conversions went up 10x as well. And then pretty soon they went up 100x. I mean, like, we drove huge amounts of value. And we went from $1 million in revenue to $30 million in revenue in like 12 months. Best Buy, Home Depot, TripAdvisor, Booking.com, all the biggest advertisers in the world used us. We would sales calls would be literally, we'd get on the phone with them and we'd be like, dynamic creative retargeting on Facebook. And they'd be like, send me the contract for millions of dollars. Like, it was like, my sales guys were very happy. I was happy. Investors were happy. It was a rocket ship. I mean, amazing. That sort of taught me what product market fit is. And now I spend all my time looking for that. It's so good. And then in Antonio's book, he recounts the story where they had a big meeting, Cheryl and all the ads guys. And the big question was, do we continue with this ecosystem play? Do we allow all of these sort of little folks like Trigit, which is the name of my company, to sort of live in our ecosystem? Or do we build this all ourselves? And the decision was made to build it all themselves and then proceed to gut us. And so for about a year, we sort of like watched the writing on the wall as they were building it themselves. And then they throttled our traffic, and we eventually were forced to sell the company. So it was a crazy journey, but I learned a lot, which was cool.
It's also a good example of process versus outcome, I would say, where if in that meeting, Zuck and Cheryl had gone in a different direction and decided, you know what, we want to keep an open platform. You were a clear leader, killing it, probably would have kept going vertical for many years and would have had some tremendous exit at some point to someone. So I think it's easy to look at that and conclude, well, platform risk is dangerous. But maybe if Zuck has a different breakfast that day or has a different mood, then, there's a very fateful decision the other way.
Yeah,
not to give you something to
no,
stare at the ceiling about at night.
I think that's right. With platform risk, what I like to say is that basically like you're mainlining jet fuel. Like with a platform, like the power you get from that platform. Like we literally, when that happened, we had 300 million in orders on our books. Like we went from 1 to 30 to 300, and we were on fire. If she had made a different decision, we probably could have gone public. But that jet fuel in your veins makes you go fast. You're off to the races, but it makes you highly flammable. The risk is just insane. And so the problem then would have become that investors, subsequent public market investors, would have looked at that and been like, oh, what happens when Facebook decides to fuck you? Because it probably will happen, and we would have gotten no multiple, so we never would have gone public. So you need to have a durable, sustainable moat, and you need to have a place that you built that basically can't be ripped out from underneath you. And so when I tell founders when they think about platform risk, I'm like, look, think about it like it's the nicest beach you've ever been to. And there's all sorts of people there because it's the nicest beach you've ever been to. It's like, oh my God, this is amazing. Like, so much business to be had here. But there's no buildings there. There's nothing there because the hurricanes come through on a regular basis. So what do you do in those instances? You build a shack that when the hurricane comes through, you don't mind if it gets wiped out. So when you build on top of Facebook, just make sure to take home the cash every day so that when the hurricane comes through, you got that cash at home. Like, don't build equity, don't build structure, don't build long-term durability on top of basically a beach that can be wiped out by a hurricane. Just build a cash business. It just generates cash. And that's fine. There's nothing wrong with that. You can build a great business doing that. Just don't assume that will be a sustainable long-term place, because it won't be, almost ever. There's no, like, if you think about platforms, the sort of Michael Porter business model strategy becomes so clear, which is that, like, their incentive is to take all of the existing players who sit between them and their customers and take their margins and drive those margins as small as possible, because every incremental dollar that you get, they don't get. And so they want to commoditize you. And so their PMs are literally looking at your products saying, ooh, what can we build ourselves quickly that does the same things these guys do, that we can integrate into our own platform and give away for free? Because all that margin will flow over to us, and then that margin will be sucked out of basically those service providers. And they do that all day long. And they're going to, so, like, I don't think you've seen any businesses that I can think of that have built really sustainably on top of these platforms. Services businesses, yes, but not technology businesses valued for the equity that they built.
I don't know how much time you spend looking at or thinking about Google, but news came out recently that one of the potential remedies from the government's point of view with Google might be forcing them to sell Chrome, which, on the topic of commoditizing compliments, felt relevant. Do you have any views on that, or Google at large?
Yeah. So one of my companies, Branchmetrics, was one of the key plaintiffs in the case with the Justice Department Google monopoly case. So yeah, I have strong opinions. They, I think it's a challenging part of any large business, is that the incentives of the employees and the incentives of the business can often be countervailing to what might be best for the world. We have to balance that. It's a challenging process, but Google, for instance, in the ad tech world that I live, has run roughshod over so many competitors. Like, they did so many things. Seeing them broken up would be good. I think the challenge is that governments are historically incompetent, and the justice system doesn't actually understand what it's doing. Nor do any of the people in the government, as far as I can tell. Like, you talk to them as someone who's been through ad tech, and they just don't understand how the world works in terms of the technologies and the companies and all the pieces of the puzzle. So it's equally terrifying to have incompetent, ignorant people making decisions that have consequential impacts. But yeah, the power of these platforms is quite large and problematic.
Can you tell us about the Zach Coelius user manual?
Oh yeah, it's great. Everyone should have one of these. Dealing with me can be challenging, and so I wrote this manual for dealing with me so that people can understand how to work with me. And so, like, basically, I say, because I tend to be messy to engage with, I wrote this user manual, and I break it into a bunch of different segments. I have communication, meetings, investing, a bunch of other stuff. Like, for instance, communication. I live in email. I treat it like I am. Don't be offended by brevity and terse emails. I do not respond to every email. Please don't call, text, or DM. Put my email in there. Blah, 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 blah. So I go through how I do my meetings, how I do all this stuff. And it's awesome. I put in all my emails. It's on my LinkedIn. It's everywhere. And people love it. The people that are most annoying are the people who don't read it and then violate it on a regular basis. And I'm like, but yeah, no, I wish everyone had one, because, we all have our own modalities of how we like to engage with people in the world. And we'd love it if everyone could understand them. And if I knew your user manual and I could read that would be super helpful. So yeah, I found it to be really good.
I had a look at your deck, and you mentioned in there no demo day investing. Curious if you can expand on that.
The way I like to think about it is, like, when you go to YC, when you're in person, it's like 1,000 other investors in the room. And a company gets up and presents. Invariably, the question is like, am I the smartest person in the room about this company? And invariably, the answer is no. There's 1,000 other people here. I know people here who are demonstrably smarter than I am in this category. And when I am the smartest person in the room, very rarely, but sometimes, let's say it's an ad tech company, almost always what happens is some idiot from Abu Dhabi or from somewhere else in the world basically overpays by 3x, and the opportunity basically is destroyed by the tragedy of the commons. And so I think demo days tend to have that happen, which is you just have a tremendous amount of adverse selection as a result of just sort of like having so many eyes on any given company, which is great for the companies. It's great for the demo day promoters. It's fine, but it just leads to a really challenging amount of adverse selection. And so I use the line, I don't do demo day investing. I have invested every now and then, but it's so fucking hard. I would much prefer, I like to see the companies. I usually invest in them well before, or well after. So I have a lot of YC companies in my portfolio and like a bunch of other companies from other sort of accelerators, but just like doing them in the demo day experience. Not to mention the timing, terrible. The transactional modality, terrible. There's just nothing about demo days that lead me to the kind of outcomes that I tend to do well in. And in fact, all my demo day investments that I've made, a couple of them have been proven to not work all that out well. So yeah, it's just terrible.
Yeah. In the moment, you're getting pre-seed traction with seed pricing is how it feels. And at the portfolio level, that feels like a hard way to make money. For the ones where you invest after, we'll say later, is that one where they're coming back and it's a proper seed or it's an A, or is it that they've gone sideways, they're looking for more capital?
When you go back to that metaphor of like going into the wilderness to find product market fit, most of the companies they go in there and they just iterate. They make changes, maybe they pivot. They're trying to figure out where product market fit is. That costs money and time. That's a challenging thing. Sometimes they go in, they find it right away and they're off to the races. So if you look at like all the YC companies, there's some of them that like from YC is kind of like a seed or an A, and then they just proceed to go. Like it's a linear, not somewhat linear journey. A lot of them have to go and iterate. And what happens is they start to run out of money. And from a portfolio construction perspective, there is a clear strategy of investing in smart people working on big markets with differentiated approaches at day one. And there's a clear strategy of investing in them once they have month-over-month growth rates, and once they have really clear sort of like any idiot can extend the line. So you can think of that as pre-seed or seed and A. Those worlds are very clear. And if you go and you invest in the best founders in each of those sort of classes, you just go in there, talk to a lot of founders, invest in the best ones, and you build a large enough portfolio, larger in the earlier stage and smaller in the later stage. That historically has worked really well, and you can usually get top quartile venture returns by doing that. In the middle there, it's really hard because it's like the founders have an incentive to lie to you because they're trying to raise money to stay alive. They haven't maybe figured it out yet. They're challenged by potentially going down the wrong directions, and so a lot of investors get really squeamish about basically investing in between basically the formation stage and the sort of like Series A stage. And usually that's where the insiders step up and write bridge rounds, and they kind of like continue to support the company. And so there, I think there's a lot of alpha as an investor to work with a company who's like, they think they've got it, but they don't yet have it on their month-over-month metrics. And so I spend a lot of my time talking to people in that area, trying to find folks who actually have found it. Yeah, that's my little niche I like to play there. It's worked well for me.
What's something you've changed your mind about over the past couple of years?
So very early on, I looked at Bitcoin. Bitcoin was like 75 cents. And I was like, this shit'll never work. So one, I'm categorically wrong. So figured that part out. Two, I've gone back and looked at my thinking on that. Like, what did I do wrong there? There's an arrogance to thinking about a thing in a particular way and then allowing yourself to be sort of funneled into the if then sort of like construction of the mindset modality and staying in that sort of funnel versus being able to step outside of that and look at that from another perspective and then allowing yourself to go down that funnel. And so in the chain of thinking for that particular instance, I was like, look, the governments are not going to want this because it's countervailing to government's best interests. And it seems to have the most value doing illegal shit, like escaping currency controls, doing things that governments don't want you to do. That's where it seems to have the most value. So therefore, governments will constrain it. Those things I think are still true. Like that's the product market fit of crypto is doing stuff the governments don't want you to do. But the mistake was, what if governments fail to repress this? At which point, like, would this become big? And then the answer is like, yeah, duh. Like, there's a lot of use cases for things that governments don't want you to do. And at which point, then the whole thing flips and it becomes, oh my God, this is the best opportunity ever. And, my life would be dramatically different at that point in time. So I think trying to, before we started this call, we were talking about how busy this job can be. Trying to manage the busyness of the job and also thinking at a multi-level, sort of multi-perspective. Is that a word? Perspective, multi? I don't know, whatever. From many perspectives. Yeah, we'll take it. It is one of the most challenging aspects of this job, but it's fun. I enjoy that part.
How do you think about scaling the firm? And part of the reason I ask is, and I'm asking for personal, selfish motivations here with this question. Like a lot of them, it's great. I get to ask smart, experienced people further along the journey. But when you have a strategy that's geared around having a really deep network, that feels like it has a ceiling on the amount of capital that can go into it before you end up leading rounds yourself, which is a different skill set, different set of muscles from, having more of a network-driven collaborative strategy. Like, how do you think about that today and where you want to take things?
I look at sort of some of my heroes who do the same work we do. And they're now people who manage billions of dollars doing the work we do. So I don't think as solo GPs. Some of them have built out teams to support them, but they're still largely the individual decision maker. And so I think it's very possible to scale. I think you have to figure out where your differentiation is and where your leverage is and where your alpha is. And I think it's going to be different for every person. But if you look at like what Oren Zev has done, like he's moved, huge amount of capital. If you look at Ray Tanzig, he's moved a lot of people. If you look at Tim Connors at Pivot North, he's had tremendous success doing a different sort of approach. There's a lot. Look at Elon. Like that guy's moving big money. So I think this business is scalable. I think you just have to figure out how to scale it for yourself. I don't think there's an easy model to it. Like for instance, scaling people. I don't think for some people that's the right way to do it. But like, I think that there's a lot of challenges inherent to scaling people. Scaling capital has a different set of challenges. You got to go in different directions. Maybe you do have to start leading rounds. Maybe you do have to start operating differently. But yeah, I think you can scale. I'm at a few $100 million in AUM now, and I think I could definitely 10x this. It's gonna be a process. It's not gonna be easy, but nothing in this business is easy. So yeah, I think it can be done.
Love it. What's a conventional view? And we'll make this the last one. What's a conventional view in venture that you think is garbage?
Oh, so many. Venture is such a tribal business because it takes you basically you do the work. You have all these ideas. Like I have all these ideas now. You do the work, and then you wait 10 years to find out if you were right because nobody fucking knows, right? And the whole business is built on that because there's the inputs and the outputs are so far apart that you you struggle with proving truth and falsity. And then you add the other layer of LPs who they go and you tell these things to the LPs, and the LPs believe these things, and then they're like 15 years of like just sitting around waiting, and so they don't really know, but they've been kind of trained by the GPs to believe these things, and then the whole thing becomes this tribal knowledge sort of infrastructure that doesn't really change. So, for instance, one thing I love to fight with my friends on is ownership. Everyone's like, ownership is good, and I'm like, from a mathematical perspective, ownership is meaningless. Like, if you take a company, and let's say we spend $500,000 to buy 5% of that company, and it's got a certain profile, so we think it has the ability to get to a certain scale, and blah 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 blah. And then you take that same $500,000 and you buy 1% of 5 companies, same profile, same scale. The probability of 5 companies achieving the outcome that you're looking to achieve versus the one company is 5x. Now you own 1/5, but you have 5x the chances of achieving basically massive outlier scale. All the money in this business gets made by massive outliers. So having more distribution of your bets so that you can be in the one is better. Net good. Like that, if the goal is to basically like achieve big outcomes, that's what you want. So owning 5% of one company is worse than owning 1% of 5 companies if all other things being equal. People's heads explode. I'm like, they don't like that. They think ownership is in and of itself a good thing. Now, there are reasons for ownership being good. Like if you're sitting on boards, you need to own a lot of the companies. Otherwise, you don't get the value of the input you put into them. If you spend a lot of work making the company really succeed and you own 0.5% of the company, you only capture 0.5% of the work that you put in. But if you own 50% of the company, you get much more of that value back to you as the individual shareholder. If you sit on a bunch of boards, you can only sit on so many boards. So therefore, you need to own a lot of those companies. Otherwise, you can't build a big portfolio. There is some value to protecting your ownership if you own more of the company from like being a major investor, et cetera. But ownership in and of itself is not anything. It's just but people in venture, nobody agrees with me on that. So
I do. I strongly agree with you. And when you said ownership inside, I felt warm and fuzzy. I was like, I'm so happy to hear this because I don't hear it often. And
yeah, but the LP community, you can't even have that. You can't even have the debate with them about this. It's just like they become brainwashed to believe that ownership matters, and so that's what they do.
Yeah, look, I mean, I'm all for owning more of winners, but my counter with it is, it doesn't matter how much you own of the company or how much you own of the winner. What matters is how much of your portfolio is in the winner. And that part seems to rug pull people sometimes. So
yeah.
Well, I'm glad we could end on something that I feel great about. This is a really fun conversation. Thanks for coming on. You're candid as usual, but it's really great and it's really fun.
Yeah, good chat. Thanks for making the time.
Hi, Joe again. Thanks for watching the show. If you'd like more of this in the future, subscribe to our channel. If you'd like to learn more about Seaplane Ventures, just check out seaplaneventures.com. Cheers.